Hey, what's up, everybody? Welcome to this live capital raising show. My name is Ellis Hammond. I am the Vice President of Capital at Aspen Funds. We are a private alternative investment firm. We serve accredited investors. To date, we've raised more than $250 million of retail capital. We've done over $61 million of distributions back to our investors. And I'm going live. I plan to go live here on YouTube, over on X as well, because we're on a path over the next 5 years to go to $1 billion of equity under management. I want to share the things that are working for us and really help other real estate sponsors, capital raisers grow and scale their capital raising business. I know that it can be insanely hard to find really good, valuable content and actually what's working in this space, especially from people who are doing it at a really high level. And so that's why we do these videos. We also partner with other fund managers, other real estate sponsors who are looking to grow their capital raising business, looking to diversify their offerings. If you already have a trusted base of investors and you're looking for another trusted sponsor, a real estate operator to work with, to raise money for, to be able to present good deals to your investors, come and check us out. You can apply at aspenfunds.us/fund manager. aspenfunds.us/fund manager. There's an application there where we can really learn about you and your business and what you're looking to do and see if it makes sense, if we're a good fit, you're a good fit to work together. But let's get into today. This is something I'm really, I've been talking a lot about lately with real estate sponsors and real estate operators. And by the way, if you're live, if you're tuning in, just post your questions here. If I don't get to them live, I'll be sure to do more videos like this. I'll be starting to post more videos on YouTube of just really good content of what we're doing. So make sure you go check me out there at Ellis Hammond. But let me tell you, I'm going to kind of tell two different journeys here. Okay. I'm going to tell you my journey. I'm going to tell you the journey of Aspen Funds and ultimately how I got here and how this applies to you. And the most important thing, I don't care if you're just starting out as a capital raiser in 2025, or maybe you've been a part of this business for a couple of years, and you've worked really hard, you've raised a lot of money, and you don't have a lot to show for it yet. I want to share with you something that is so extremely important for you to focus on in 2025. And I'll just go ahead and give it to you and then I'll tell you the two stories. The number one thing to focus on 2025 is cash flow. If you do not have cash flow, you do not have a real business. That's the answer. Like, cash flow is the lifeblood of a business. You're not able to continue to operate and grow without a consistent cash flow stream. And it is something I'm really passionate about helping other people learn because of my own journey. And so a little bit about myself. I started as a college pastor, and I was, part of I was more than a college pastor. I was a college missionary, really, where I was sharing my faith and building Christian communities on college campuses all around San Diego. And part of my job was raising money. That's how I learned to start raising support and asking people for dollars. And, that began to translate into doing my first real estate deal, into my second real estate deal, et cetera. And then we became, private equity entrepreneurs, real estate entrepreneurs, and raising money for large multifamily deals. And I've had tremendous success over the last 7 years. I would say I've been in one of the top percentiles, at least in the circles in the syndication space of raising private money. And we've done really well in that regard. And we've bought, we transacted over 1,200 multifamily units. But here's what I didn't know, which I do know today, is that even though I was really successful in raising a lot of money and we were able to buy a lot of multifamily deals, everything that I was focused on was back end loaded. Meaning, yes, we made fees when we purchased a deal up front, but those fees, because they weren't reoccurring, they had to go towards, everything was really reinvested back into the business. It was reinvested back into growth. It was reinvested back into legal documents and, due diligence cost, right? And all the things in serving your investors. And so most of the money that I've earned was, and really what we were building was kind of a back-loaded company, meaning we get paid when the deal closes, right? Or when we exit the deal, the equity that we're building from the operations of the company and the asset, which is fine in some ways. The problem is, put yourself in the shoes of, in a lot of people's shoes, especially in multifamily, today is it's really risky, where maybe even a lot of that equity is not even there anymore because of where values have shifted. And then not only that, you can't run your company, you can't run a business or grow a business off of equity. Now, let me tell you the story of Aspen Funds. Aspen Funds started 11 years ago in the great financial crisis, and they identified an opportunity in the distressed mortgage note space. And they began to buy pools of distressed mortgage notes and turn non-performing notes into performing notes. And they started what was called an income fund, which at the time was paying 9% to investors every single month from the performing notes in the portfolio. And then Aspen was earning a fee, a recurring fee off of that fund as well. Fast forward 10 years later, actually 11 years later with Aspen Funds, guess what? They still have the same income fund that is still every single month for over a decade paying 9% a month to investors and is generating massive amounts of cash back to the business in recurring revenue every single month, every single year. And it is the foundation that has given Aspen the ability to launch into broader private alternative investment opportunities like we have today with our private credit fund. We are about to launch, our upstream energy fund number 7. We have an industrial portfolio that we're growing here in the Midwest, Kansas. And so it is the tale of, it's kind of the tale of it's two different tales. It's two different narratives that I want to show you today and show you like, which one would you rather have, right? Would you rather have a lot of equity, which is fine in some ways, or would, if you're serious about growing a business, that's what I'm speaking to today. And cash flow is the lifeblood of that. And if I could go back and start over, that's what I would focus on. And it's why I'm here, because I love the story of Aspen and I love what we're doing here. And it just began to make sense to me. And so when I kind of had this realization, I was like, okay, this is what I'm going to go do to start over in a sense. I had the opportunity to come work with Aspen. Instead, I said, well, man, heck, like we're 10 years ahead, right? Well, I want to come be a part of this and help build upon this. And maybe you don't get that opportunity to come join a firm like Aspen Funds, but it's not too late to do the same thing. And so I think this is so important. And so what a couple of things that I've shared or will be sharing in future videos is what I would do if I was starting over. And that would be the biggest advice I would give to anyone today is focus on cash flow. And I'll show you a scenario of just how practical or like how powerful this is. Let me see if I can share my screen with you here as I pull this up. Let's see here. Slide up. Yeah. Give me a second while I pull this up. That's okay. It's not showing. I was going to show you a cool example of how this actually plays out from a number standpoint. But as I'm pulling this up, here, let me just grab this here. All right. Yeah, here we go. I got you. Let's go. All right. So this is what I want to show you because this is so cool to look at and think about if you're just starting in this business. If you were to focus on a vehicle that would pay you 3% recurring revenue, which by the way is very possible. We have a private credit fund right now that pays fund managers anywhere from 2.5% to 3% on the money that they raise on an annual recurring basis. Okay, because it's an evergreen fund and we have AUM fees, right? And so we and then we have profit above that which we lend on, right? And so we are able to share that. We earn that. We share that with our fund managers. And so, fund managers can earn anywhere from 2.5% to 3% on the money that they raise. So this is very possible. It's why figuring out the vehicle first is probably the most important thing that you can do. And, I think a lot of people get started and just like, hey, I'm going to go start with the people that I have in my space because that's where I can go raise my first dollars, which is fine. But again, if you're thinking long term, the type of assets that maybe create recurring revenue to help you build and grow a business, the people that you have in your circle may not be the best avatar for that type of investment, which is why I would recommend take a step back and think about the vehicle which you're going to go in, and does it have the sustaining power to build massive amounts of recurring cash flow for you and your family. Okay. And so let me just show you the example that I'm talking about here. So if you were to raise $1 million in your first year, okay, you now have $30,000 in recurring revenue, which again, nothing life-changing, but it's a start. Okay. Many of you, if you have great networks, can probably raise a lot more than $1 million. But all of a sudden, you now have a $30,000 recurring revenue that you can get going on. This is the power of being a fund manager, a capital raiser, right? And building a business around raising money. Year two, let's just say you're able to do the same activity, or maybe even half the amount of activity, because your current investors, which you're paying every single month, invest again in year two, which again, this is another key thing that I learned starting out. If you start with, let's say, a development deal, or maybe even a multifamily deal that has kind of a longer stabilization period, and you're not able to pay investors early, then when you go to ask them for the second investment, what are they going to say? They might most often say, I want to see how the first deal performs. Where if you do a deal, I had a great mentor tell me this one time. He says, every investor thinks you're Bernie Madoff until you send in 2 distributions. Right? And it's true. It's because, this space is still like the Wild West in a lot of ways. And people want to know that you're legit. And how do they know you're legit? If you send them money. And so if you started with a vehicle that's sending them money every single month, well, then by the time year 2 comes around, they're very likely to want to put more money with you. So in year 2, you've now raised $2 million at the end of year 2 at 3% recurring revenue. Now you have a total of $60,000 $60,000 in additional recurring revenue. Now you have $90,000 in total recurring revenue. Starting to get a little more exciting. Maybe some of you can, think about leaving your current W-2. And then year 3, let's look at year 3, because this is where the trust begins to compound. And I think people underestimate that. Well, what is the quote? You overestimate what you can do in a year, but you underestimate the potential of what you can do in 3 years. And, here's the thing that I think, especially in the culture we live in today, is everybody wants it right now. Right. But if I could say, hey, I'll give you $1,000 today. Okay, I'll give you $1,000 today, or let's say in 3 years, I can guarantee you that you'll be making $180,000 in recurring revenue, but for 3 years, you can't earn anything. Which one would you take? In most cases, you would take the second one. However, we don't live life like that, do we? No, we typically want to take the thing that's immediate. But if you know anything about success or study anything about success, is those who have the ability to delay gratification are often those who are most successful in life, right? Because they realize that why would I sacrifice and give up the upside later for a small piece today? So here's the thing. Check out year 3's example. Going back to the model here, year 3, let's say that you were able to only increase by 50%. Okay, so you raised $3 million in year 3 at 3%. Now you have an additional $90,000 in recurring revenue. You have a total of $180,000 in recurring revenue if you're earning at 3% on the money that you raised. Okay, and I know there's probably attrition here that we're not factoring in, but the reality is in these type of investments, especially if you're working with folks who are investing retirement money, the attrition rate is not very high. I mean, we have folks who have been with us for a decade. And so, you're replacing that, you're raising more. Some folks are coming out. It is what it is. And in most of our funds, we have a 1 to 2 year lockup period. So typically they're not coming out until, in this scenario, they wouldn't be coming out until year 3 if they wanted to get out. So now you have $180,000 in recurring revenue, which is pretty attractive, right? Like you're getting into the multiple 6-figure mark, or at least you're at least getting close. But here's the compounding effect of trust. Imagine this. For many of your investors, you've been sending them a monthly distribution for 2 years, meaning they trust you, they like you, They see that, you know, you're a good fiduciary of their money. And so what do you do in year 3? You also, let me actually come back, say, hey, instead of doing the 9% dividend thing or the 10%, whatever, I'm going to go do something that has bigger upside in the, you know, in later years. It's not necessarily going to create more recurring revenue for me, but I can start to build equity by doing kind of longer play deals. So in the same year, not only did you raise an additional $3 million for your fund, you raised another $1 million to just the investors you've been paying in an upside deal, something that creates upside or equity for you. And so you earn $30,000 in revenue from one-time fee, but you also are earning $100,000 in equity that you're building from the project. So in year 3, you've now made $210,000 in revenue and over $100,000 in equity. And this is the power of this business. Now that I can stop sharing with you guys, what I wanted to just share and kind of open your mind to the power of capital raising is it takes time to grow, but not as long as you think. And it is the ability to build a very profitable cash flowing business is here. And I would say this is the thing that I wish someone like myself today would have came on and told me, Ellis, focus on building a recurring revenue business and forget vanity metrics. That's what so many, you know, I'm going to a conference later this month, which, you know, I think the founder of this conference is great, but there's a lot of vanity metrics that people are talking about. How much money did you raise? Right? How big is your investor base? Let's get a trophy for how much money you raised. Who cares? Let's ask the question, how much cash flow did you earn this year? How much money were you able to not only give to your investors in dividends, and how much cash flow did you actually earn as a real estate sponsor? That is really the only thing that matters. So this is what that's the first thing I wanted to share with you today. I wanted to, just now that we're live here, to give you a couple of things that we're doing here at Aspen Funds. Again, we're on a path to, we've raised about $250 million of equity, and we, total over the lifespan of this business. And our goal is to be $1 billion equity firm by 2030. And so what do I focus on a day-to-day basis? Well, I have the privilege of being part of a company that has a team. We have a wonderful investor relations team. I have 2 full-time investor relation, what I would call advisors or specialists. And we have a full-time concierge who's doing a lot of the admin. So it allows me to be able to focus on things of growing and scaling our operations. And the thing that I'm most focused on today is growing our investor leads. Like, how do we continue to build a pipeline, a consistent pipeline of leads? And I'll tell you this, it's definitely easier if you have money, but you have to remember, for 7 years, I ran a business and I did not have the recurring cash flow. And so I had to do a lot of things that were on a budget. And so regardless of where you're at, I'll kind of share both. And it really starts with having a really good lead magnet. Okay. What can you give someone in exchange for value? Especially if you don't have any money. And so this is something that we're spending a lot of time working on. We spend a lot of time testing, is just, hey, what do people want? And I'll tell you the things that work really, really well. Early in my career, I created an investor checklist. So a due diligence checklist of, here are the 49 questions that you should ask every real estate sponsor before you invest with them. And I would give that out, or I would go on a podcast show, or I would do a YouTube video like this, and I would talk about the top 3. And I would say, hey, if you want the next 46, go to my website or go to this link and download the other 46 questions. And that would be how I would start to grow my investor base. So checklists work really well. Reports work really well. I'll give you a little insight since you're watching this live, is that I'm working, we have over 800 investors. And so I'm able to survey those investors and actually get live data into, based on what they share, live data into their allocation spread, what they're investing in, how much passive income they're earning, et cetera. And so we're working on a really cool report to be able to share publicly on the, our accredited investor allocation report, which I think will be a really, really cool downloadable report that people want. This is a great example. I got this idea from Tiger 21, which is a kind of a national high net worth community. I think you have to have a $10 million net worth or more. And every single year they survey their members, and then they share that as a lead magnet to say, hey, here's what our members are investing in 2025. Here's what they're going to be investing in. Here's their allocation. Here's how much cash, stock, real estate, etc. That's so valuable. You don't actually have to be part of the community to download that. But guess what? You see that, you say, man, if this is what they give me for free, how much value would I get if I was an actual member of their community? And the same thing should be true for you. Man, if they're giving away this for free, how much more value would I get from them by actually being a client? And that is the power of a lead magnet. So reports work really well. Webinars work really well, right? So we do, we just completed our 2025 economic forecast, where our founder, Bob Fraser, who's an expert in macroeconomic strategy and data, will actually come on. He puts together an hour and a half presentation, and we go live. And we say, hey, we're doing this live webinar, register. We promote it everywhere. We spend money on Facebook ads. We say, hey, come and learn on what are the trends in 2025 that you as an investor must pay attention to both avoid pitfalls and also take advantage of huge opportunities, right? That's what people want to know. What should I avoid? What should I take advantage of? And so we do a 2025 webinar. Like, most of my strategy here is webinars. Like, we do a webinar, I think every other week we're doing a webinar, rather that's a deal webinar or an educational webinar, because one, it's a great way to stay top of mind. It's a great way to position yourself as an expert in the space. It's a great way to grow your lead. So it kind of does everything, right? We can cross promote. We just did a webinar this week on the state of the market for oil and gas, because we have a big oil and gas opportunity that is about to come up. So not only are we positioning ourselves as the experts, which we are, in the content that we have, we're able to start to slowly promote to our current investor base and any new investor that was there, the opportunities that we have coming up, right? So a webinar I love because, one, you can get new leads, you can see who's engaged, you can cross promote the opportunities you have coming up, and you build trust and credibility with your investor base. So I love webinars. Podcasts are good, or something like this is good. The problem or the hard thing about a live show or a podcast is that, which again, we're super bullish on the podcasting space. We're launching a new podcast here at Aspen and putting a lot of money into making that a really great podcast show, Invest Like a Billionaire. But it's harder, in my opinion, to get people from listening to actually go download something, right? And so it's more of a long play, where I would say the play for a podcast is more of a relationship building and trust building. Once someone comes into your ecosystem, what are the next steps they can take to download and to listen? And it's a great way to talk to people one-to-many. And so if I was starting out, I wouldn't necessarily go straight to the podcast route, because again, it's harder to grow your list that way. But I think for someone who is more established in 2025, I'm so bullish still on podcasting. I'm so bullish on YouTube Live, right? I'm so on X Live, right? Because in this space, you don't have to have, like, my goal for me is not to have 1 million subscribers. That would be cool. So if you haven't subscribed, that'd help me a ton. But my goal is not to have 1 million subscribers. My goal is to have a very, devoted, like we don't need 1 million people to become $1 billion firm, right? We need we have 800 people that we've put together $250 million of equity. So just 4x that is only a few thousand, right? So that's the power of this space. And even partners and fund managers, we don't need 150 fund managers. We'd like to have a few dozen, right? And so you think about the power of content. And this is why, like, I'm trying to write exceptional, great quality content, because I want people who are really engaged and are really devoted to the type of stuff we're doing here at Aspen. So anyways, I hope that's super helpful. All right. I think I've ran it enough for today. This was super fun. Listen, if you are interested in learning more about working with us as a fund manager or capital raiser, you have the experience, you're someone that can really put together over $1 million. You're looking to diversify your real estate offerings. Again, what I love We have a lot of real estate sponsors that already have their own real estate deals that work with us. Why? Because if you've already built the trust with an investor base, and maybe you don't have, let's say you're doing something more exploratory or high risk that doesn't create recurring cash flow for you, why not partner with someone trusted like Aspen that has funds that have been around for a decade, right? We've been managing funds and doing things like that for over a decade. We have a very loyal investor base. Why not work with someone like us to offer the same opportunity? Again, you can have your own SPV, your own fund of funds. We never have to talk to your investors. You've already built the trust. So there's no extra work than say, hey, here's an opportunity where you can actually create a recurring income stream for yourself, investor, and for you, sponsor, by working with someone like Aspen Funds. We'd love to have the conversation with you. Go to aspenfunds.us/fund manager, aspenfunds.us/fund manager. There's an application there you have to apply and have a conversation with our team about next steps, and we'd love to have that with you. So, hey, if you enjoyed this, leave a comment, even if you're watching this later, and let me know your questions. Let me know the things that came up for you. I would love to address those in future videos. And again, you can follow me on X at Ellis_Hammond or on YouTube at Ellis Hammond. Be sure to follow and subscribe there, and we'll continue to create great content like this. Thanks so much, everybody. Talk soon.